Buffer ETFs have been on fire. They grew into this $50 billion category really overnight. I'm only exaggerating a little bit. And when it comes to a product such as T-Jewel, or not T-Jewel, rather, Max J, I mean, who is this for? Eric calls them boomer candy. Is that fair?
They actually have been attractive to a variety of investors, but I think right now the growth has really been for the investor who, first got, concerned, as did many investors, given the huge sell-off of markets in 22, and then in last year was the year of cash, where you could actually maintain a very defensive portfolio position and still earn some yield. And now with Fed cuts on the horizon, the question is around that very short fixed income or cash allocation in your defensive portfolio positioning. How can you participate in markets and limit that downside? And I think that has really grown the interest in these, we call outcomes product and the buffered suite of products.
Yeah, the reason we use the boomer candy metaphor is that, older boomers have most of the money. So odds are it's them buying ETFs through their advisor. But the other thing is they don't have a lot of time. And if you look at 2022, as you said, the aggregate bond index was down 13%. Stocks were down 19%. You got no help from your 40. Your 60 goes down, the 40 should go up. That's what they're used to. That happened in 2008. And look at this, AGG has not kept up with inflation over the past 10 years. These are two big strikes against that. I think these could make a real run for that 40 section of the portfolio. What do you think?
If they are priced well and they deliver to investors what they say they're going to deliver, yes, absolutely. And I think that is, you guys have had some great conversations here about retirement and how retirement is becoming a much kind of broader set of challenges, including how to manage a portfolio for a longer period of time in retirement where you need some growth.
And real quick, let's talk about that upside, 11.4%. T-Jewel, which you mentioned earlier, is the innovator one, I believe, and that's, I think, around 10%. So you've kind of pushed the envelope a little. How do you get out that extra, percent or two of upside?
So one of the things we love about ETFs is because they're so transparent, there's not really any secret sauce, and you showed the holdings. So there's difference in structuring, and I think this is really important for investors to understand, particularly if they start to participate more in derivatives-based products. So when you do a buffered type product, the general way you structure it is you are going to buy a put option to give you the downside protection, sell a call option you sell off some of the upside to fund the downside, and then you have to equitize the portfolio. There's two different ways to equitize the portfolios. The standard, which is what was done in most of the buffered products, which was to buy a zero strike call, and to buy the underlying, which in our case is IVV. Now, options math would tell you those things should be the same. However, the zero strike call is actually much more balance sheet intensive.